When the property market crashes, you're gonna need a plan. In this video, I'm sharing exactly what my playbook looks like so I can prepare for what's coming next if the market goes up or eventually goes down. If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. Now on Instagram, if you aren't following me, it's Personal Finance with Ravi. Go ahead and follow it because I share so much content every single day for absolutely no cost. Now on my Instagram, I often ask the community and people that follow me to ask me any questions and I give those answers. And one of the most frequently asked questions was, hey Ravi, how are you preparing for the next property market crash? Something that I want to cover off in real good detail here, but if you're also interested in strategies around lending and property market updates, I'm running a free webinar, which I'm going to leave link in the description box below for. It's absolutely free. I'm also doing a live Q&A. It's on the 25th of November. So come join me. I can't wait to meet you. It's completely virtual, so you can join from anywhere around the world. Now, I want to provide some context. I want to look at some data. I want to look at some numbers. And then at the end of this video, I'm going to share with you my step-by-step process of what I'm doing right now. And it's probably going against the grain because I see this as a game. And I want to bring you into my mind and the psychology behind how I'm approaching property investing, why I might be holding some cash back, and how I'm preparing this market to go and 10x my net worth in the next 10 years. Now, I just mentioned, thinking of it like a game. Now, this game of investing is all market psychology. It's consumer behavior. It's something that I deeply resonated with when I was at uni, and I went through it and said most of this was crap, except for this one subject. It's about human psychology and consumer behavior. Why do people purchase and why do people freak out? And humans are predictable because it happens every single time. So if you think about it, when the market's going up, everyone's euphoric, everyone actually wants to be in the market. So most people will want to buy when the market's trending higher, and most people don't buy when the market's trending lower. That's why you'll often see is that there's more activity when the prices are higher and there's less activity at the bottom of the market. It's depressed, nobody wants to buy. Now, before I go on to the rest of this video, I'm going to share with you some real data that's going to go against this 18.6 year cycle that everyone talks about, which is I can just sell at the top and then just sit pretty and then buy more real estate and become really wealthy because some cycle says so. I'm going to go through that in a little bit, but I've got to give you the big disclaimer. I own a lot of real estate. I have a lot of debt and I run a 50 full-time staff buyer's agency that goes out and secures property every single day. In fact, we purchase about 20 to 25 properties every single week. So you might be thinking, well, in that case, you're going to be biased towards the upside, right? Well, it's actually that I'm biased towards the downside. I would actually personally prefer if the market went down rather than up. And it's actually better for my business and better for me personally, despite the fact of being in the market. And I know that's counterintuitive, it's the contrarian way to look at it, but that's the reality. Because think about it, I'm still going to make the same transaction value on something that's going up in value versus going down in value. In fact, when it's going down in value, I can pick up better deals for clients, I can pick up better deals for myself, and there's less competition. So I would want a market that's a bit slower. When the market's going up, you've got everyone going out there purchasing property, they're going and bidding up prices. Some unsophisticated buyers and other buyers agents as well are going out there and purchasing with no clauses, absolutely taking the risk for their clients, and that's not a market I want to be playing in. So the stock levels of really good real estate reduces. So I've got to give you that disclaimer because people are going to say, well, you run a buyer's agency, you want prices to go up, and I actually want them to go down. But I can't lie to you. I have to tell you the truth, which is I'm going to go through the data and then we'll figure out what the worst case looks like and then how I'm preparing. Now let's look at this table, which is the Australian average home prices after the first RBA rate cut. And this goes back to 1982. What you'll see is 3 months after the first rate cut, 6 months, 12 months, and then 18 months. And we're going to look at what actually happens to house prices. So we can see in 1982, prices fell by 1.4%. 6 months later, minus 2%. 12 months later was 4.5%. And then it was minus 2.6% 18 months later, which effectively means it continued going down for about 12 months and then it started recovering and going higher. Let's take a look at 1986. And while we're looking at this, what I want you to take away, because most people miss this, is the world is very different from back then to right now. And what I mean by that is the amount of money printing, the debt ceilings, the debt levels around the entire world, as well as quantitative easing that we have now is very different to 30, 40, 50 years ago. So just take it with a grain of salt because when you have larger amounts of debt, small movements in interest rates make a massive difference. So keep that in mind as we go through this. Now in 1986, 3 months was minus 0.6%, 0.3% at 6 months, then an increase of 2.6% at 12 months, and then 7.9% at 18 months. Here we saw the recovery between 6 and 12 months, and then an absolute booming market 18 months later. Now in Jan 1990 and 1996, what you can see is that things started changing, where we didn't see a decline at all. In fact, what we saw was prices increase from the 3 months after that. However, in the 1990s, we saw prices go down and then further decrease at the 18-month mark. Whereas in 1996, we saw an absolute mammoth boom, which is very similar to 2001. In 2001, we saw prices increase from word go. So as soon as the rates decreased, we saw it increase by a massive 3.6% at the 3-month mark, then 8.5% at the 6-month mark, and then 16.2% at the 12-month mark, and then 25.8% at the 18-month mark, which is absolutely crazy. And obviously rates alone didn't cause that to happen. Now in September 2008, we obviously saw the GFC around the world, and we saw prices go down by 2.2%, started recovering, but also still went down by 1.3% at the 6-month mark, and then went up by 4.9% and then 11.6% at the 18-month mark. What we're looking at is the average. And what we can see is at the 3-month mark, it increases by 0.2%. At 6 months, it's increased by 1.2%. And then at the 12-month mark, it's 3.9%, and then 8% at the 18-month mark. Which means it's safe to say that because we've had a few rate cuts this year, based on this, we can assume that prices will head much higher. And when you start throwing in a lot of other factors like supply constraints and lending conditions changing, you could most likely see a property market that's going to boom closer to what we've seen in 1996 and 2001 versus what we saw in 1982. Now, what I want to focus on is the reality of a crash. And what I do is in my spare time, and yes, I'm a nerd, so don't judge me, but I will often sit there and I will try and find data and find trends in how things are moving and why things work, especially when it comes to real estate, finances, and whatnot. So I like to have really long and riveting conversations with ChatGPT and then go and cross-reference that with my own data and go and research all of that stuff in my free time. Now, as I've said on this channel before, I could share with you all of that research and you will get bored out of your brains. So what I did instead was I said, look, I want to consolidate this into this one table on ChatGPT so I can show you guys exactly what I'm thinking and how things could play out. Because in my head, the way it works, if we're looking at playing out with the 18.6 year cycle, we've often been told that 2024 to 2026 is the peak of the market. That should be the winner's curse, which means markets absolutely rip and they go up everywhere. And then we have this massive crash. Well, my question is, what happens if it doesn't play out? Because right now the theory is that, oh, well, it happens every time, so it has to continue happening. Irrespective of what the factors are in this market, it will continue to follow the trend. In fact, according to the 18.6 year cycle, we should be at the peak. This is the worst time to buy apparently. And by 2026, so within the next 12 months, we should see prices go down. It's very hard to see how that happens in Australia when you have supply where they are, immigration numbers are still very high, you have really tight rental vacancy markets, you have lending conditions starting to loosen up, and you also have rate cuts in play. So when you factor in all of that, you're starting to hear commentary of, oh, it might not happen in 2026, it might be 2027, or maybe it's 2028. So I just want to get really clear with this. Is yes, cycles play a really big part in human psychology, and they have a place when you're making decisions. However, you've got to go into the micro. That would be me saying that blanket rule, this is what's going to happen because it's happened for the last 200 years, and I don't know what the factors are, but that's how I'm investing. You might do okay, but for me, I spend all my time in this space. So what I do is I look at data and I see what's happening on the ground, which often is leading to what's happening in the data space, and then that's leading to what the cycles look like. And what I can tell you is something that I've held really true to my heart over the last couple of years, despite the noise and despite the hate, is I don't think the market slows down in 2026. I think it actually re-accelerates. I think that if we're going to see a correction, it's more likely to happen in 2028 versus 2026. And if that were to play out and you were sidelined, what does that actually look like? Well, let's go through this scenario and consolidate it into a table and give you an insight as to how I'm thinking. So here we have a $650,000 home and what it would look like if there was a 2028 correction. Now, we have the starting level, which is 2025. In 2026, I believe we're going to have growth closer to about 15%, but I've sandbagged it at 12%. And then in 2027, which we could probably reach the peak at towards the end of 27, and that's going to be an increase of 10%. Let's assume we have a correction in 2028. And what I've done is I've got scenario A, scenario B, and scenario C. Scenario A assumes that we have a decrease of 9%. Scenario B is a correction of 15%, And then scenario C is a correction of 20%. Now keep in mind, the largest fall in real estate house prices since 1970 in Australia, national house prices, was 12.7% between mid-2017 and mid-2019. And why did that happen? Well, it was nothing to do with cycles. In fact, it was all to do with APRA coming in, the Royal Commission coming in, and having an inquiry around responsible lending. So what we saw was massive changes in how money was lent out from banks towards customers. So that's what affected that decrease in prices. We didn't have interest rates absolutely taking off like they did in 2021 and 2022, but that's been the worst case scenario that we've seen over the last 30 years. Now, could it play out differently? Well, yeah, of course. It's life. I could be hit by a bus today after this video, and that would be really sad. But the reality is you're not gonna know what's happening in the future. What you can do is look at the past, learn from it, and then prepare accordingly, which I'm gonna share with my playbook as we get to it. We need to get to it though. Come on guys, stop distracting me. So we go back to this table and we see that if we bought a house today, $650,000, we assume the 12% growth, it means that 650K goes to 728. And then let's say we go up by another 10%, that house is now worth about $800,000. Now let's assume that 3 scenarios play out. We've got in scenario A that we have a correction in 2028 and it goes down by 9%. That would effectively mean that we've seen a drawdown from the peak of about 9%, which means even after the correction, your property is now worth $728,000, which is still 12% higher than where we are today. Now, in scenario B, we can see that the price is now $680,000 post the correction, but you'd still be higher by about 4.7% at that time. Now, keep in mind, the worst correction was 12.7%, and that was due to the lending restrictions. Now, in scenario C, which we haven't seen here in Australia in a very, very long time, and why I say very long time is because the dynamics of the market have completely shifted, and they've shifted from 2020, let alone 30 years ago. And if you don't understand that, you don't understand quantitative easing and monetary policy, as well as the money supply and how debts in the world are so much higher now relative to incomes, why that entire dynamic is different to every other time we've seen it before, I'm not sure I can make a video that detailed right now, but I have big conviction around why we won't see a 20% decrease. So if we did see the worst case scenario, in my opinion, at 20%, if you bought today at 650, that property would now go from 650 to 640 and it would be down 1.5%. So when you zoom out and you buy the right real estate at the right price, it doesn't actually make a huge difference. Now you could go on to say, well, what happens if I bought in 2027 and then the market corrects and then I've lost a lot of money? Well, yeah, we'll cross that bridge when we get there because we aren't in 2027 and we aren't purchasing in 2027 yet. In fact, even if you purchased in 2026, there are still strategies that can still put you ahead by having purchased versus not. And the reason I say that is because when the market is crashing and you're someone who hasn't been active, what you're gonna do, and this comes out to human psychology, is you're gonna say, well, oh, the price has gone from 800 to 720, I don't wanna buy. It's gone from 720 to 700, I don't wanna buy. The same asset that was worth 800, you're still not wanting to buy at 700K. What's the chance that it gets to 680? In fact, when it doesn't get to 680 and it starts pumping back up, you're someone that's gonna be closer to buying at 800, if not higher than that, because you want to buy in a market that's trending higher, not lower. And this is something that happens time and time again. People don't want to buy when the market's going down, they want to buy on the way it's going up. It's that whole concept of sell when others are greedy and buy when others are fearful. So now that we've established some context and what could potentially play out, let's have a look at what my strategy is and how I'm preparing for it. Again, I'm biased more towards the downside, not the upside, and I can just rely on the data. And the data says one thing, which is the shortfall in terms of supply that we have in Australia. The government themselves have come out and said, we're actually not going to meet that demand until 2029 to 2030. If someone said to me that we might see the correction in 2029, that makes a lot more sense because there's more supply now. And whenever you've seen an increase in supply and it increases above demand, we see a slowdown for a couple of years. We do see a slowdown in the price growth and price appreciation in many areas. Now, that's not to say every area is going to be affected the same way either, because you might have a lot of supply come into the one area, but another area still has 10 buyers and only 6 properties for sale. That market's not going down. But what am I doing right now? I've got a robust strategy and it's very key that I keep updating this, which I do. In fact, I do it probably every fortnight, and that's more so because I operate in the business of property. So I need to be hands-on when you've got a team of 50 full-time staff. you're paying a lot of wages. So you need to be someone who's prepared for what comes around the corner, whether it's positive or negative. Now, as a byproduct, it also leads me to think about my own portfolio and how I'm prepping for things for myself, but also a lot of my clients. I care a lot about my portfolio, but I care more about my clients' portfolios purely because I don't want to be held responsible for screwing over people. That's just bad karma. It's not cool. Because if I lost my money, yeah, I could go and make it back. But if I lose someone else's money, that does not sit well with my values. So I'm always seeking and being ahead of the curve because I have to be. So if I wanted a game plan around building wealth and securing financial freedom, I'd have a strategy, I'd get the right people in the team, get your brokers, get your accountants, get your buyer's agents, a really good one. I'll link the one that I founded personally and why we've helped hundreds and hundreds of Australians secure financial freedom, so you can book a free call. But I always will have an emergency fund. So if you're going out there and purchasing the property for say 600, 650, 700, you want to have at least 10 to 15K as an emergency buffer. And always remember what got told to me, I'm now passing on to you. If you can buy, you should buy. It is so simple at the core, but you realize that what you're doing is you're trading out this currency that you have no control over, that continues to lose its value. There is data that suggests that it's going down at a rapid pace and has been going down ever since it came out, which is the Australian dollar. And you compare that to hard assets. So what you're doing is you're exchanging this currency for an asset that is proven to continue holding its value over the long term. So if I can buy, I am buying. Now, I did say earlier that even if you did purchase in 2027 and the market was going to correct in 2028, you still have a lot of options. And what you could do is similar to what I would be doing is at the end of next year, being end of 2026, I'll start taking away a lot of the equity in my property portfolio and have that sit in an offset account, as well as be able to go and purchase more real estate. So be very selective around where I'm purchasing, but I'm still buying in 2026. In fact, if I don't see things change in 2026, I'm still as active in 2027. And again, in 2027, I'm using and extracting that equity out so it sits there as a position for me to go and be active in the market, but I'm still active in the market. Again, I'm not blowing all of my money come end of 26, start of 27, but right now I'd be going all in. And my version of all in is very different to your all in, and what you're purchasing and how you're purchasing is very different. But if you're looking at getting started or you're building out that foundation property portfolio, then you want to be active in the market. You want to be getting runs on the board. Because there is this one concept that I often think about is what happens if there's no crash? Let's play out that scenario. Because at the moment, everyone in the market wants it to actually crash, like I do, because if it crashes, I can now go out and buy a cheaper real estate, which I know is going to go up in value over time. So if I can do that in a market that's, supporting that with interest rate cuts, you've got such a severe shortage, it's putting large upward pressure on demand and large upward pressure on prices. So of course you'd want that. But the market will do the opposite because it wants to keep people offside as long as possible. So a lot of people are thinking, if it crashes, then I can buy. What happens if it doesn't? What happens if we have a great year of growth in 2026 and then in 27 we have the same thing? And by 2028, 2029, what we do is instead of growing at 10%, we might grow at 1% or 2%, or the market just goes sideways. And that means that you would never enter the market because every year you're not in the market and it continues moving further ahead. You're holding your cash that continues to lose value, and there's a place and time for holding cash. But if you hold no assets at all, that is the biggest risk. So it is very different when you're buying real estate versus when you're buying shares and buying Bitcoin, because you could go out there and say the market crashes today, you could go out there, buy shares in a company and it's the exact same. But if you go out there and try and buy in a market that's now depressed and no one wants to sell, there might not be an opportunity for you to buy in that market. And as long as demand is higher than supply, markets will continue to hold up and be robust. Hope you guys have enjoyed this video. Hope it gives you some insight as to how I'm preparing. If you have any questions, let me know in the comments down below. I'd love to catch you on the webinar as well. And if you aren't catching it live, the webinar link below will still give you access to the replay. If you guys have enjoyed this video, if you have, smash the subscribe button and I'll catch you guys in the next one. Thanks guys.